When making decisions, it is sometimes important to consider the relevant financial information. In other words, we must consider the relevant costs and the relevant revenues. In this presentation, we are going to focus on the relevant costs associated with decision making. A relevant cost can be defined as a future incremental cash flow. These terms are important and form the basis to understanding much of relevant costing. So let's take a look at each in turn. Future. We are interested only in future costs. Any costs that have been incurred in the past are ignored. These past costs are referred to as sunk costs. Incremental. Only costs that arise as a direct result of the decision are relevant. So, costs which are non-specific or fixed would be ignored. Cash flow. Relevant costing is only concerned with cash flows. Non-cash flow items, such as depreciation for example, are not relevant as there is no cash flow linked to depreciation. Let's apply the concept of relevant costing to typical cost items we see arising. Let's firstly consider material cost. When trying to assess the relevant cost of material, we need to consider, firstly, whether the material required is in stock. If it is not in stock, then the material must be purchased, meaning the relevant cost, or future incremental cash flow, is the current purchase price. If the material is in stock, then we need to consider if it is currently used elsewhere in the business. If it has no other use in the business, then the relevant cost of taking and using this material is the resale proceeds lost, or scrap value lost, from not selling or disposing of the material. If the material is used elsewhere in the business, then we must assess whether this material can be replaced. If it can be replaced, then the relevant cost is the current purchase price paid to replace what we have taken. If it cannot be replaced, however, it is considered to be scarce, and to calculate the relevant cost, we must consider the contribution that has been lost as a result of not using the material elsewhere in the business. Let's consider three scenarios where we put these principles of relevant costing of material into practice. Scenario 1. A Limited is considering a project which requires 100 kilograms of material. The material is in regular use within the business. There are 400 kilograms of material in stock which were purchased for $1.40 per kilogram. The current purchase price is $2 per kilogram. What is the relevant cost of material to A Limited? As the material is in regular use, whatever is taken from stock will ultimately need to be replaced. 100 kilograms of material is needed, all of which is currently available in inventory. So these 100 kilograms would need to be replaced at $2 per kilogram, meaning a total material cost of $200. This represents the future cash outflow in respect of material as a result of the decision of A Limited to undertake the project. In other words, the $200 is the relevant cost of material. The $1.40 is a sunk cost and is not relevant to the decision. Let's take a look at another example of relevant costing regarding materials. Scenario 2. B Limited is considering a project that requires 100 kilograms of material. The company has 500 kilograms in inventory, which were purchased some years ago for $1.50 per kilogram. However, this material is no longer in use within the business. The current purchase price is $2 per kilogram of material. B Limited could sell each kilogram for 90 cents. What is the relevant cost of the material to B Limited? As the material is no longer in use within the business, any stock taken will not need to be replaced. However, taking 100 kilograms of inventory from the warehouse means that B Limited will not receive the resale value or scrap value of 90 cents for each kilogram. Thus, the cash flow impact of using 100 kilograms of material is $90, being 100 kilograms multiplied by 90 cents each. This represents the relevant cost of the material to B Limited. Note that the $1.50 is a past cost or sunk cost and is excluded from our analysis. Also, the current purchase price of $2 is not considered here. Scenario 3. C Limited is considering a job that requires 100 kilograms of material. 350 kilograms of material are in inventory. Material is no longer available to purchase, and if it is not used by C Limited on this proposed job, it would be used in the manufacture of product K. Each unit of product K uses 4 kilograms of material and generates a contribution of $10 per unit. What is the relevant cost of the material to C Limited? The material is in inventory, but is no longer available to purchase. This means that the 100 kilograms required could not be replaced. However, if taken, then 25 units of product K, being 100 kilograms divided by 4 kilograms per unit, would not be produced or sold. This would result in lost contribution of $250 to C Limited, the $250 being made up of 25 units of product K multiplied by $10 per unit. Thus, the future incremental cash flow impact of using 100 kilograms of material for this job is $250. Relevant costing principles can also be applied to the use of labour by a business to undertake a particular job or project. If there is spare labour capacity or idle staff within the business, then the relevant cost is zero, since putting this labour to work on the project does not represent an additional cost to the business. However, if there is no spare capacity, then perhaps the company could hire more labour or work overtime. If so, then the relevant cost is the cost of hiring that additional labour or working that overtime. If hiring additional labour or working overtime is not possible, then labour is deemed to be scarce. Thus, to undertake the proposed job, labour would need to be reallocated from elsewhere in the business. This means the relevant cost is the opportunity cost of moving the labour, being the lost sales proceeds less any savings in material costs. Let's put these principles into practice and consider 3 scenarios regarding the relevant cost of labour. Scenario 1. D Limited is considering a project which requires 100 hours of labour. Currently, there are 180 hours of spare labour capacity. Workers are paid $5 per hour. An agreement stipulates the staff cannot be laid off. And the question is, what is the relevant cost of labour? If D Limited decided to go ahead with the project, the relevant cost of labour will be nil. As spare labour capacity exists and labour is already paid, there is no future cash flow associated with putting that labour to work. Scenario 2. E Limited is considering a job which requires 50 hours of labour. There is no spare labour capacity. However, additional staff could be hired at a rate of $6 per hour for this project. What is the relevant cost of labour for this job? The future cash outflow associated with the job is $300, being the 50 hours of required labour multiplied by the rate of pay of $6 per hour. Hence, the relevant cost of labour for this job is $300. Scenario 3. F Limited is considering a project which requires 100 hours of labour. There is no spare labour capacity and it is not possible to hire additional staff. Labour would have to be removed from the production of product T in order to undertake this project. Currently, product T is sold for $50, incurs direct material cost of $10, and requires 1 hour of direct labour at a cost of $8. And the question is, what is the relevant cost of labour for this project? In this case, the relevant cost, being the future cash flow impact as a result of undertaking the project, would be the opportunity cost of not producing product T. Staff would have to be diverted from producing product T in order to work on F Limited's other project. As 100 hours are required for the project and product T needs 1 labour hour for each unit, then 100 units of product T would not be completed. So, the cash flow impact of diverting the staff from product T would be the lost sales proceeds of $50 per unit, less the material cost of $10 per unit that would be saved. The opportunity cost of not producing 1 unit of T is $40, meaning a total opportunity cost, or relevant cost, of $4,000, being $40 per unit multiplied by 100 units, given that 100 units of T would now not be produced. Let's consider relevant costing in relation to overheads. An overhead is a relevant cost if it is specific to or attributable to the decision being considered by the company. So, a variable overhead or a fixed overhead, which are incurred as a direct result of the company's decision to undertake a particular job, are considered to be relevant costs. However, non-specific or general fixed costs are not incremental and are not relevant. Also, if a fixed cost is said to be absorbed or allocated, then this is usually indicative of that fixed cost being general, not specific. Let's take a look at an example regarding the relevant costs of overheads. G Limited is considering whether to add an extension to its building. If added, variable overheads of $10 per hour would be incurred. The extension would also absorb building fixed overhead charges at an absorption rate of $8 per direct labour hour. And the question is, what are the relevant overhead costs per month if 9,000 labour hours are worked in each month? The relevant cost of the variable overhead is 90,000, being 9,000 hours multiplied by the variable overhead of $10 per hour. The relevant cost of the fixed overhead is nil, as no additional fixed cost is incurred. In other words, the cost is not incremental or specific to the building extension. So overall, the total relevant cost in relation to overhead is 90,000. Relevant costing can also be considered in relation to non-current assets. The relevant cost of a non-current asset can be referred to as the deprival value. In other words, if the company were deprived of a non-current asset, what's the least amount the company would have to receive to be no worse off than it is now? There's a formula we can follow which will determine a non-current asset's deprival value. This is calculated as the lower of the asset's replacement cost and its recoverable amount. The recoverable amount is the higher of the asset's net realisable value, being the fair value less cost to sell, and its value in use, being the present value of its future cash flows. Let's take a look at an example. H Limited purchased a machine some years ago for 23,000. The machine could be sold today for 13,000. If it is kept within H Limited's business, it will generate 18,000. An identical machine could be purchased today for 15,000. The question is, what is the relevant cost of using the machine on another job? The relevant cost of a non-current asset is the lower of its replacement cost and its recoverable amount. The machine's replacement cost is 15,000. The recoverable amount is the higher of the net realisable value of the machine, 13,000, and its value in use, 18,000. So 18,000, being the higher amount, represents the most that H Limited could expect to recover from this asset. In other words, 18,000 is the recoverable amount. The relevant cost is the lower of the replacement cost of 15,000 and the recoverable amount of 18,000, meaning the relevant cost of the machine is 15,000. In other words, if H Limited were deprived of this machine today, then the least amount of cash it would need to receive in order to be no worse off than it currently is 15,000. In summary then, A relevant cost is the future cash flow impact of a company undertaking a particular course of action, usually making a decision, undertaking a job, or considering a project. Relevant costing principles can be applied to material, labour, overheads, and non-current assets. Typically, each of these items is considered separately.
In this session, we are going to look at how costs, revenues, and profits interrelate with each other. We will explain the nature of cost volume profit, or CVP analysis, learn how to calculate the break-even point and the margin of safety, calculate the contribution to sales ratio and what this means, calculate target profits and revenues, produce break-even charts and profit volume charts to help us to interpret cost and revenue data, and we will also look at the limitations of CVP analysis for planning and decision making. Cost volume profit analysis is used to determine how changes in costs and volume affect a company's operating income and net income. There are a number of techniques that can be used to help us understand how changes in cost and volume impact on profits. The first thing that we are going to look at is the break-even point. As the name suggests, this tells us the volume of sales at which we make a zero profit. In other words, we break even. So to make a zero profit, we just need to ensure that our fixed costs are covered by the contribution that we make selling our product or products. Remember that contribution is calculated as sales revenue minus variable costs. So if we know the contribution we can make for each unit we sell, the selling price per unit minus the variable costs per unit, we can work out how many units we need to sell to cover the fixed costs. The break-even formula therefore can be defined as fixed costs divided by contribution per unit. This will tell us the volume of units we need to sell in order to break even. If there are multiple products within the business, we need to use a weighted average contribution per unit on the bottom of the formula, and this can be calculated by taking the total contribution and dividing through by the total volume sold to generate that contribution. We can then multiply the break-even volume by our selling price per unit to find the break-even revenue. We can also calculate the break-even sales revenue using the contribution to sales ratio, as we will see later in this video. We can extend the break-even formula further to find the margin of safety. This is the difference between our budgeted sales volume and the break-even sales volume, and this will therefore tell us how far our sales volume can fall before we start making a loss. We can calculate the margin of safety as an absolute figure or as a percentage. The absolute figure is, as mentioned a moment ago, budgeted sales minus the break-even sales volume. To find the margin of safety percentage, we would take this absolute figure and divide it through by the budgeted sales volume and then multiply up by 100%. The larger the margin of safety relative to the budgeted figures, the better, as this means that sales would have to drop some way before we start making a loss. Given that we have just mentioned the contribution to sales ratio, let's look at this next. The name of the ratio tells us how to calculate it. We take the contribution per unit and divide through by the selling price per unit. If there is more than one product in the mix, we cannot use this formula as the contribution and selling price per unit is likely to be different on a product-by-product basis. Instead, we need to use total contribution divided by total revenue, and this will generate a weighted average CS ratio covering all products. The CS ratio tells us how much of our revenue is converted to contribution to cover our fixed costs. The higher the CS ratio, the better, as this means that we are generating a higher contribution per dollar of revenue. So if a product sells for $2 and has a CS ratio of 50%, this means that we have generated $1 of contribution per $2 of revenue, or 50 cents of contribution per dollar of revenue. Whereas if the CS ratio were 20%, we are only generating 40 cents of contribution per $2 of revenue, and therefore we need to sell more units to generate the same overall total contribution to cover the fixed costs. I mentioned earlier that we can calculate the break-even revenue using the CS ratio. We do this by taking the fixed costs, and instead of dividing through by contribution per unit, we now divide through by the CS ratio. Clearly, where there are multiple products in the mix, the CS ratio used needs to be the weighted average CS ratio, as covered above. We can also extend the break-even calculations to find a target profit or target revenue. Let's look at target profit first. The formula will now become total fixed costs plus target profit divided by contribution per unit. This means that the contribution generated not only covers the fixed costs, but also the profit we are hoping to generate. The target revenue can be calculated as the target profit multiplied by the selling price per unit, or fixed costs plus target profit divided through by the CS ratio, in much the same way as we did for the break-even revenue. If there are a number of products to consider, we need to remember to use the weighted average CS ratio on the bottom of the formula. We are now going to move on and look at the break-even and profit volume charts that can be produced and how they help us to interpret the relationship between costs, revenues and profits. Let's first look at the break-even chart. The axes for this graph are monetary amounts on the y-axis and units sold on the x-axis. We are going to plot a line on this graph for total revenue at different sales volumes and a line on the graph for total costs at different sales volumes. The revenue line is fairly straightforward. We assume that the unit price does not change at different sales volumes, and therefore the revenue line can be plotted by calculating the revenue at two different sales volumes using this fixed selling price per unit. So if we said the selling price was $10 per unit, this would give us revenue of $20,000 if we sell 2,000 units and $30,000 if we sell 3,000 units. The line will also cross through the origin, of course. No sales equals no revenue. With these figures we can plot the line on the graph. We now need to plot the total cost line. This will incorporate fixed and variable costs. Again, we assume that the variable cost per unit does not change despite changing output levels. We also assume that fixed costs remain the same at all output levels. The first thing we need to do is mark the fixed cost on the graph. Even when we make no sales, we will still incur these fixed costs, so when the sales volume is 0, we can mark a point on the y-axis for these fixed costs. Let's say the fixed costs are $5,000. If the variable cost per unit is $4, then we can add on a further $8,000 at a sales volume of 2,000 units, and a further $12,000 at a sales volume of 3,000 units. This gives a total cost of $13,000 at 2,000 units and $17,000 at 3,000 units. These points can be plotted on the graph to create the total cost line. Notice that the total cost line does not start at 0 but at the fixed cost of $5,000. Now that we have the total revenue and total cost lines both plotted on the graph, we can find the break-even point to be the volume at which the lines cross, and therefore total revenue equals total cost, and neither a profit nor a loss is made. If we track this point back to the x-axis, we can see that the break-even point is at approximately 850 units. Using the formulaic approach already detailed, we can work out the break-even point to be $5,000 divided by $6. That's the selling price of $10 minus the $4 variable costs, which gives us 834 units. We always round up so as to make sure a small profit rather than a small loss. Another point to note with regards to the graph is that at sales volumes to the left of the break-even point a loss would be made, as total costs are higher than total revenue, and sales volumes to the right of the break-even point would generate a profit, as the total revenue is higher than total costs. The cost volume profit chart, or profit volume chart, plots exactly what it says, profits made at different sales volumes. So using the same data that we used for the break-even chart a moment ago, we can produce a profit volume chart. We know at our break-even point of 834 units we make neither a profit nor a loss. And we know that when we sell no units at all, we still incur $5,000 of fixed costs, and will therefore make a loss of $5,000. So using just these two pieces of data, we can plot the profit volume line as seen on the graph. We can see from the graph that at sales volumes lower than 834 units, we would make a loss, and at volumes above 834 units, we would make a profit. If we have a budgeted sales volume, we can also see the margin of safety on the graph. So if our budgeted sales are 2,000 units, the margin of safety falls between 834 units and 2,000 units. So it is 1,166 units. The chart we have just plotted is only relevant in single product scenarios, so we now need to look at the situation with regards to multiple products. The first thing we need to do is rank the products based on their CS ratio, and then much like we do in limiting factor analysis, we decide which product to make first, which to make second, and so on. We then calculate the total profit made at each output level and chart this on the graph to find the break-even point. The easiest way to demonstrate this is with some numbers. A company makes and sells 3 products, alpha, beta, and gamma. We know that the revenue generated by alphas is $12,000 and the variable costs of making them is $5,000. This gives a contribution of $7,000 and a CS ratio of 58.3%. If we perform the same calculations for beta and gamma, we can see that their CS ratios are 36% and 33.3% respectively. So we would rank alphas in first place, followed by betas, and then gammas. In order to plot the graph, we also need to know the fixed costs for the business. So let's assume that they are $9,500. This means that with a sales volume of 0 units, we will make a loss of $9,500, and this gives us the starting point for our graph. We then need to know the cumulative profit we will make if we make the products in the order in which they have been ranked. So selling alphas generates $7,000 of contribution, giving us a net loss of $2,500. If we then sell betas, we generate a further $9,000 of contribution, and therefore we make an overall profit of $6,500. Making gammas generates another $7,000 of contribution, and now the profit becomes $13,500. We also need to know the cumulative revenue generated with each product. So selling alphas generates $12,000 of revenue, adding on the revenue from betas gives us $37,000 in total, and adding on gammas gives us $58,000 in total. Plotting these points on the graph gives us a line that looks like the one shown here. Notice that the x-axis is now sales revenue rather than sales volumes. From the graph we can determine the break-even revenue to be around $16,000. If we had calculated the break-even revenue using the weighted average contribution as covered earlier in the video, this would have been the fixed costs of $9,500 divided through by the weighted average CS ratio. The total contribution generated by all 3 products is $7,000 plus $9,000 plus $7,000, giving us $23,000, and therefore the weighted average CS ratio is $23,000 divided by the total revenue of $58,000. The break-even revenue under this method is therefore. This is different to the $16,000 calculated by the graphical approach, as this calculation ignores the ranking process and gives all products the same priority. The graphical approach is much more accurate and tells us that we can break even at a lower sales revenue if we prioritise production, as we will ensure that we maximise the contribution being made and therefore we cover the fixed costs more quickly. The final area that we need to cover on this video is the limitations of these various techniques, some of which I have already touched on throughout the video. All of the methods assume that fixed costs are constant at all output volumes, and that there are no stepped fixed costs. The methods also assume that variable costs and selling prices do not change as output and sales volumes change. This implicitly means that we are assuming the efficiency and productivity are also constant at all output levels, and that there is no learning curve effect or price-demand relationships. We are also assuming that whatever we produce we sell, so that there are no changes in our inventory levels. And finally, there is an assumption that fixed and variable costs can be split, and that there are no semi-variable costs within the business. In this session, we are going to think about what happens when a business is short of a particular resource, and how we can ensure that that resource is used most effectively to produce the highest profits for the business. We call this topic limiting factor analysis, and this is a crucial topic area for short-term decision-making within any manufacturing business. You should note that some businesses may have other objectives rather than profit maximisation, but for the purposes of this video and this topic area, we are going to assume that profit is the main objective for any business. The main types of resources that could be scarce or limited are labour hours, machine hours, or materials. It is possible that more than one of these is in short supply, but this cannot be dealt with using limiting factor analysis. Instead, you would need to use linear programming, which is covered on another video. This video will therefore focus on what happens when just one resource is scarce, either labour hours, machine hours, or a single material used within the production process. The first thing we need to do when considering a problem of this nature is determine which resource is scarce. It is possible that there are details provided to you that suggest more than one resource is limited, so you need to determine which resource is the one that is actually limited. The way that we do this is by looking at total demand for each product we make, and how much of each resource is needed to meet that maximum demand. This will identify which resource, if any, does not allow us to fulfill the demand, and it is this resource that is classed as the limiting factor. Let's consider this scenario. Percussion Limited has demand for 2,000 units of product Zing. Each unit of Zing takes 3 hours of machine time, 2 kilograms of material pop, and 8 hours of labour. Percussion has the following resources available: 8,000 machine hours, 4,500 kilograms of pop, and 15,000 hours of labour. To make the 2,000 units, Percussion will need to utilise 6,000 machine hours, that is 2,000 units multiplied by 3 hours per unit, 4,000 kilograms of pop, 2,000 units multiplied by 2 kilograms per unit, and 16,000 hours of labour, 2,000 units multiplied by 8 hours per unit. As Percussion Limited only has 15,000 labour hours available, this is our scarce resource and the factor that will limit our production. Given that there are only 15,000 labour hours available, this means that Percussion can only make 1,875 units, calculated as 15,000 hours divided by 8 hours per unit, rather than the full demand of 2,000 units. Once we know what the scarce resource is, we then need to plan our production volumes to ensure we optimise the use of the resource and thereby maximise profits. Remember, we are always going to assume that profit maximisation is the main objective of the business. The easiest way to cover this is to go through an example. Here we have Good Job Limited. They make 3 products: the good, the better, and the best. Demand for each product is 2,500 units, 1,500 units, and 1,000 units respectively. A single unit of good takes 2 labour hours, 4 machine hours, and 1 kilogram of material X. A single unit of better takes 3 labour hours, 3 machine hours, and 1.5 kilograms of X, and each best takes 4 labour hours, 2.5 machine hours, and 1.75 kilograms of X. Good Job Limited has the following resources available: 14,000 labour hours, 16,000 machine hours, and 7,000 kilograms of X. So, as before, the first thing we need to do is calculate the scarce resource. Let's consider labour hours first of all. To make the 2,500 units of good, we will need 5,000 hours. To make 1,500 betters, we need 4,500 hours, and to make 1,000 bests, we need 4,000 hours. This totals 13,500 hours, so is within our capacity of 14,000 labour hours. With regards to machine hours, we will need 10,000 hours to make 2,500 units of good, 4,500 hours to make 1,500 units of better, and 2,500 hours to to make 1,000 units of best. This totals 17,000 hours, which is more than the 16,000 hours available, and is therefore a limiting factor or scarce resource. For completeness, we should also look at material X to ensure that this isn't also a scarce resource. We will need 2,500 kilograms of X to make 2,500 goods, 2,250 kilograms to make 1,500 betters, and 1,750 kilograms to make 1,000 bests. So in total we need 6,500 kilograms, which can be covered by the 7,000 kilograms we have available. We now know that the only scarce resource is machine hours, so we now need to plan our production based on this restriction. In order to determine how many of each product we should make, we need to know how much money we can make from each product. Our focus is to ensure that we look at how much money we can make per machine hour, as this is the resource we are trying to make the best use of. The way we find this is to calculate the contribution per unit of scarce resource, machine hours in this case. But before we can do that, we need to know the contribution per unit. To find this, we need to know the selling price per unit and the variable costs per unit. In the case of Good Job Limited's product range, the following data applies. The selling price for a unit of good is $27, and the variable costs are $5 for materials, $16 for labour, and $4 for variable overheads. This gives a contribution of $2 per unit. A better sells for $41 and variable costs total $37.50, giving a contribution of $3.50 per unit. And a best sells for $51.50 with variable costs of $48.25, giving a contribution of $3.25 per unit. At first glance you might conclude that the best product to make is the better, as it generates the highest contribution per unit. But we need to bear in mind how many machine hours it takes to make each unit, so that we maximise the total contribution we can generate from all of the products we can make with the limited 16,000 machine hours. Now that we know the contribution per unit, we need to take this one step further and calculate the contribution per machine hour, so we need to remind ourselves of how many machine hours each product takes. A good takes 4 machine hours to make, so the contribution per hour is 50 cents. A better takes 3 machine hours, giving a contribution per hour of $1.17, and a best takes 2.5 machine hours, giving a contribution per hour of $1.30. Based on these figures, we can now see that the product that makes the best use of the available machine hours is the best, so we will want to make as many of these as we can before moving on to making betters, which generate the next best contribution per machine hour, and then finally we can use up any remaining hours making goods, which generate the lowest contribution per machine hour. Having worked out which order we should make our products, we now need to calculate how many of each we can make with the available machine hours. Starting with bests, we should make the full demand for these if we are able to with the available machine hours. If each best takes 2.5 machine hours to make, and total demand is for 1,000 units, this means we would utilise 2,500 hours to make the 1,000 units, leaving 13,500 hours available to make betters and goods. The total demand for betters is 1,500 units, and they each take 3 machine hours, so a further 4,500 hours will be utilised to make these, leaving 9,000 hours that can be used to make goods. As each good takes 4 hours to make, we can make 2,250 units with this remaining 9,000 hours. The demand for goods was 2,500 units, so we can see that we cannot make 250 units given the restricted machine hours. The final step we can take is to work out the total contribution we will generate by following this production plan. We can use the contribution per unit that we have already calculated and multiply this by the number of units from our production plan. Each best generates a contribution of $3.25 per unit, and we plan to make 1,000 units. Betters generate $3.50 contribution per unit, and we plan to make 1,500 units, so the total contribution for betters will be $5,250. And goods generate $2 contribution per unit, and we plan to make 2,250 units. The total contribution for all three products being made is therefore $30,000. In this session we will look at what happens when there is more than one limiting factor, and how we can make the best use of the limited resources that we have to ensure we continue to maximise profits. The process we are going to use to do this is called linear programming. As with limiting factor analysis, we are always going to assume that the main objective of any business is to maximise profit for the purposes of our calculations. For more information on limiting factor analysis, please see the separate video covering this area. There are a number of steps we need to go through to calculate the maximum profit or contribution that can be generated when there is more than one limiting factor. The first step is to define the variables. We then need to understand our constraints and turn this information into formulae. We will also turn our objective of maximising contribution into a formula. Once we have our various formulae, we can then produce a graph, and from this identify a feasible region, which is the area of the graph within which we meet all of the various constraints. Within this feasible region will be the optimal production plan, which is what we are aiming for. Once we know our optimal production plan, we can then calculate the maximum contribution we can generate in much the same way as we do when performing limiting factor analysis. We will use the remainder of this video to demonstrate this process with an example. Alphabet Limited makes two products, the franc and the greeter. Each franc generates contribution of $5 and takes 10 labour hours to make and 4 kilograms of material L. Each greeter generates $7 of contribution, uses 5 labour hours and 6 kilograms of material L. Alphabet wants to maximise contribution, but there is a limited number of labour hours and also a limited amount of material L available, so they cannot meet maximum demand for both franc and greeter. They have 1,000 labour hours per week and 800 kilograms of material L available. Alphabet Limited want to be able to make more greeters than francs, as the demand for greeters is usually higher. So step 1 is to define our variables. Let us say that F is the number of units of product franc and G is the number of units of product greeter. We will also use C to represent total contribution. Based on this data, we can start to put together some formulae to stipulate the various constraints. So with regards to labour hours, we know that each franc takes 10 hours and each greeter takes 5 hours, and that we have a maximum of 1,000 hours available. This generates the formula 10F plus 5G needs to be less than or equal to 1,000 hours. Moving on to material L. A franc uses 4 kilograms of material L and a greeter uses 6 kilograms of L, and we have 8 kilograms of this material available for use. The formula to describe this is therefore 4F plus 6G needs to be less than or equal to 800 kilograms. We also need to ensure that we make at least one franc and one greeter, as the company wants to make some of each. The formula that covers this is F, G needs to be at least 0. With regards to demand, Alphabet want to make more greeters than francs, so we can define this formula as G being greater than F. And finally, we can state the objective function, which is to maximise contribution. This formula is based on the contribution that each unit of franc and greeter can generate, and therefore it becomes C equals 5F plus 7G. Now we need to draw a graph with number of units of franc and greeter on the two axes of the graph. To plot the graph, we need to perform some workings using the formulae that we have just put together. Let's look at the formula for labour. This is 10F plus 5G is equal to or less than 1,000 hours. We hope to use the full 1,000 hours, so we can turn this formula into 10F plus 5G equals 1,000 hours. For the purposes of plotting the line on the graph, we are firstly going to assume that we make no francs. So this means that the formula becomes 5G equals 1,000. and therefore G is 200 units. We can follow the same principle by assuming that we will not make any greeters. This time the formula becomes 10F equals 1000 hours, and therefore if we don't make any greeters, we can make 100 francs. We also follow the same idea with regards to material L. The formula that we produced was to state that 4F plus 6G needs to be less than or equal to 800 kilograms. Again, we are going to assume that we use the full 800 kilograms and turn the formula into 4F plus 6G equals 800 kilograms. If we assume we don't make any francs, the formula becomes 6G equals 800 kilograms, and therefore G is 133 units of product greeter. Assuming we don't make any greeters, the formula becomes 4F equals 800 kilograms, and we would therefore make 200 units of franc. So now we have some parameters to put on the graph. We need to plot these points on the graph. For labour, we can mark a point on the G-axis at 200 units and a point on the F-axis at 100 units, and then join the dots together to give the labour constraint line. We can do the same with material L and mark a point on the G-axis at 133 units and on the F-axis at 200 units, and join these together. This is the constraint line for material L. We can also plot the demand line on here as F equals G. We need to ensure that we make more greeters than francs, so anything below this line is within this constraint. Now that we have the constraint lines on the graph, we can determine the feasible region. As already mentioned, we need to be to the right of the demand line as we need to make more greeters than francs. We also need to be below the constraint lines for material L and for labour, as we cannot use more of the resource than we have. This gives us the feasible region, as highlighted in bold, of 0, A, B and D. Given the constraints we have, we can make any combination of volumes of francs and greeters within this region, but we want to maximise contribution, so we now need to add a further line to this graph, the contribution line. We need to work out the angle of this contribution line, and the easiest way to do this is to follow a similar process to the labour and material constraint lines. But this time we don't have a contribution figure, so the first thing we need to do is work one out. We are going to use the contribution formula of C equals 5F plus 7G, together with information gained from our graph. If we look at point D of the feasible region, F is 0, and G is 133. Using these unit volumes in the contribution formula gives us C equals $5 multiplied by 0 francs plus $7 multiplied by 133 greeters, totaling $931 of contribution. We can then use the contribution formula, this time assuming that G is 0, to find how many francs would also generate $931 of contribution. So $931 equals 5F plus 7G, but as G is 0, this becomes $931 equals 5F, and therefore F must be 186 units. We can now plot a line on the graph where the point on the F-axis is 186 units and the point on the G-axis is 133 units. This is the contribution line. Once we have plotted this line, we need to effectively slide the line up across the graph until we reach the furthest point within the feasible region. By moving the line up and to the right, we will ensure that we maximise the contribution generated, as we are making the maximum number of products. In this case, the last point we hit within the feasible region is product B, so generating the quantities at this point will maximise contribution. We call this the optimum point of production. We now need to look at point B and determine how many units of franc and greeter are recorded at this point. By tracking back to the F and G axes, we can see that this leads to an optimal production plan of 50 francs and 90 greeters. Now that we know the optimal production quantities, we can work out the maximum contribution that can be generated using the contribution formula. The maximum contribution that can be generated given the constraints within the scenario is $880, calculated as $5 multiplied by 50 units of franc and $7 multiplied by 90 units of gruyere.
In this session, we're going to think about how much extra a company would be willing to pay for one additional unit of scarce resources. The topic that we'll be covering in this video is all about shadow prices. This is an extension of limiting factor analysis as discussed in the previous two videos. A shadow price is the additional contribution generated from one additional unit of limiting factor. Or, in other words, we can say that it is the opportunity cost of not having the use of one extra unit. A shadow price is the maximum extra amount that a company would be willing to pay for one additional unit of scarce resource. A shadow price is not the maximum price which should be paid, but rather it is the maximum extra that a company would be willing to pay over and above the current purchase price for a limited resource. Let's say, for example, that a company has reached its maximum capacity for its permanent labor force. They may consider hiring in temporary workers or paying their current workforce overtime. Management will want to know what the maximum amount that they should be paying for the temporary staff should be, or the amount of overtime they can actually afford to pay. If a company is not utilizing the maximum availability of one of their resources, we call this slack. This may occur when we have a limited amount of material and an overcapacity of labor hours, or vice versa. The workers will run out of material to work with eventually and will sit idle until additional material is purchased. Or on the other side, we'll have material that will be stockpiled as we do not have enough labor in order to convert this material into product. If the entire resource available is required for the optimal solution, then the company will be willing to pay a premium, a shadow price, to obtain the additional resource. If the company does not require all the available resources for the optimal solution, then they will not be willing to pay a premium and there would be no shadow price. This is when slack occurs. Let's consider the following scenario. A company makes two products, X and Y. Sales demand of X is 10,000 units and sales demand of Y is 12,000 units. Direct labor and production are restricted to 60,000 direct labor hours and direct labor is paid at $10 per hour. It takes 5 hours to produce 1 unit of X and it takes 4 hours to produce 1 unit of Y. The contribution per unit of X is $8 and the contribution per unit of Y is $6. Based on the above information, the optimal production plan has been calculated to be 10,000 units of X and 2,500 units of Y. What is the shadow price per direct labor hour and for how many additional hours of labor does this apply? Usually in this type of question we would be required to calculate the optimal production plan, but in the scenario above this information has already been given to us. Make sure that you are able to calculate this optimal production plan yourself. If you have trouble with this, please go back and re-look at the video on limiting factors. Let's now consider what would happen if one additional labor hour was available to purchase. In other words, what would we pay as an overtime rate? Because we have met the demand of X in the optimal production plan, the company would use any additional labor hours to manufacture product Y. There's no need to produce any additional product X. The contribution that would be earned per additional unit of product Y is $6. Therefore, the additional contribution per direct labor hour would be $6 divided by 4 hours, which would equal $1.50. This is the shadow price, the maximum extra that the company would be prepared to pay for an additional hour of labor. Therefore, the maximum price that the company would be willing to pay for each additional hour would therefore be $10, which is what they pay for a normal direct labor hour, plus the shadow price of $1.50, which equals $11.50. Once the company has met the demand of Y, the labor would no longer be a limiting factor. Therefore, once they have made an additional 9,500 units of Y, the shadow price will no longer be applicable. Therefore, the shadow price would be applicable for the next 38,000 hours. 9,000 units of Y multiplied by 4 hours. Now that we have looked at calculating the shadow price for a single limiting factor, what happens when we have multiple limiting factors? Let's consider the following scenario. In a linear programming problem, to determine the contribution maximizing production and sales volume for two products, X and Y, the following information is available. It takes 2 direct labor hours to make product X and 4 hours to make product Y. There are a total of 10,000 direct labor hours available. Product X uses 4 kilograms of material and product Y uses 2 kilograms of material. There's a total of 14,000 kilograms available. The contribution per unit is $12 and $18 for product X and product Y respectively. The total contribution at this optimal production plan is $54,000. The optimal production of X and Y has been calculated as 3,000 units of X and 1,000 units of Y. This would be calculated using linear programming since there are two limited resources, labor and material. It's important that you are able to calculate this optimal level of production. If you're struggling with it, please do look back at the video on linear programming. Using this information, we need to calculate the shadow price of one additional hour, i.e., what is the contribution that the company will make if they receive one additional unit of labor. Therefore, we need to calculate the contribution using simultaneous equations as if one extra additional labor hour were available as follows. Equation 1 for labor hours would be 2x plus 4y equal to 10,001, 10,000 plus the additional hour. Equation 2 for materials would be 4x plus 2y equal to 14,000. Please note that we are only changing one limited factor at a time. In this case, we're calculating the cost of an additional hour of labor rather than material. In order to solve this simultaneous equation, multiply equation 1 by 2. Create a third equation, 4x multiplied by 8y equal to 20,002. Subtract equation 2 from equation 3 to get 6y equal to 6,002. And therefore you'll get y equal to 1,000.33. Substitute this into either equation 1 or 2 to get x equal to 2,999.33. You can now calculate the total contribution of this production mix. 2,999.83 units of X at a contribution per unit of $12 plus 1,033 units of X of Y at a contribution of 18 per unit gives us a total of $54,004. Compare this to the original contribution of $54,000. The additional contribution and therefore shadow price is therefore $4. This is the extra amount that the company will be willing to pay for one additional hour of labor.
In this session, we are going to consider the different ways in which a business can price its products or services. There are three main approaches to pricing: demand-based pricing, cost-based pricing and market-based pricing, and we will deal with each in turn throughout this video. We will also consider other influences and factors that need to be considered when making pricing decisions. Before we look at the different methods of determining a price for a product or service, let us think about why it is important to get the price right. In order for any business to make a profit, it needs to sell its products or services for more than it costs to make them. So you might say, well, why not just set the price really high and then you can be sure that you have covered all of your costs? The problem with that, of course, is that customers may not want to pay the high price you are charging, and therefore the number of products you sell will be low and your fixed costs may not be covered. So there is a balance to be had between the selling price and the volume sold, and therefore the subsequent profit being made. And as already touched on, there are a number of factors at play here that need to be considered when setting a suitable price for a given product or service. In order to be able to think about the best price for a product, we also need to think about what might influence the price, and there are a number of factors that need to be considered. Price sensitivity. Some products are more price sensitive than others, and some customers will be more price sensitive too. If a product is price sensitive, it means that the volume of products sold will vary dramatically as the price increases or decreases. Price perception. This refers to the way in which customers react to price changes. For example, some people perceive that a high price means that they are buying something a bit more exclusive or luxurious than a lower priced similar item, and they are therefore prepared to pay the higher price for the kudos associated with the product. Quality. This is linked with price perception. Some customers equate higher prices with better quality, and again will be prepared to pay a higher price in order to buy what they consider to be a higher quality product. Competitors. Clearly, any business needs to consider what their competitors are charging and decide whether they want to compete on price or compete based on other factors such as brand loyalty, quality and so on. In some industries, like the petrol industry, you can see that prices change almost en masse. As one company changes price, they all follow suit. Inflation. This will have an impact on the costs we are incurring, and therefore a business will need to decide if they want to pass the increased costs on to the customer by inflating their selling prices, or whether they would prefer to keep prices as they stand and take a hit to their profit. Newness. New products, particularly in the technical sector, can often command a higher price as customers are generally happy to pay a premium for being one of the first to adopt the new product. Incomes. Here we are talking about the income of the customer. In the case of the general public, as disposable income increases, people are happy to pay more for goods and services. We therefore often see prices rising when an economy is strong and falling when an economy is weak. Product range. If a product sells interrelated products, they will need to think about the pricing strategy across the range of products rather than item by item. Ethics. A business needs to think about whether they wish to take advantage of shortages in a product or service and increase their price given that demand will be high. This might of course have a negative impact on their reputation, so they need to weigh up the pros and cons of such a move before initiating any price change. Now that we have considered the various factors that might influence our pricing strategies, let's look at the different approaches we can take to pricing. The first approach we are going to consider is demand-based pricing. As the name suggests, the prices we set under this approach are based on the demand we expect, or have historically seen, for the product or service in question. It is assumed that there is a linear relationship between price and volume. As prices rise, sales volumes drop, and as prices drop, sales volumes rise. How the volume is affected depends on the price elasticity of the product or service. A product that is more price elastic will show a big change in sales volumes as prices change. Think of luxury holidays and designer clothes. Whereas a product that is price inelastic will show a small change in sales volumes as prices change. These are usually basic or necessary products and services like milk, bread and petrol. We can calculate the price elasticity of a product or services using the formula PED, which stands for price elasticity of demand, equals the percentage change in demand divided by the percentage change in selling price. A PED of greater than 1 means that a product is price elastic, and a PED of less than 1 means the product is price inelastic. If the PED is exactly 1, this means that the change in demand is equal and opposite to the change in selling price, and the overall revenue generated through sales is the same. We can look at a quick example to demonstrate this calculation. The price of a loaf of bread increases from $1 to $1.20, and the supermarket goes from selling 1,000 loaves per day to 900 loaves per day. We want to know what the price elasticity of demand is for the loaf. To calculate the price elasticity, we first of all need to calculate the two components within the calculation. So the percentage change in demand can be calculated as 100 loaves divided by 1,000 loaves, the 100 loaves being the drop in sales from 1,000 loaves to 900. This gives us a 10% change in demand. And the percentage change in selling price is calculated as 20 cents, that is $1.20 minus $1, divided by the original price of $1, giving us 20%. The PED is therefore 10% divided by 20%, so 0.5. This is less than 1, showing that the price is inelastic, as would be expected for a basic item like a loaf of bread. The price elasticity of a particular product may well change over time as demand for the product changes, and there are a number of factors that could affect the demand and therefore the price elasticity. The price of other products that could be used as substitutes for the product in question. If substitute prices are lower than the price of the product we are trying to sell, then in all likelihood demand for our product will drop. As already discussed, customer income will have a direct impact on the demand for certain product types. Tastes and fashions change, and therefore demand for products will also change as fashions move on. As technological changes are seen, some products will become obsolete, and as a result there will be a drop in demand for an item that may have seen steady demand in the past. In order to estimate demand for a product, we can use another formula called the demand equation, which states that P equals A minus B multiplied by Q, where P is the price of a product, A is the price where demand is 0, B is the demand line calculated as change in price divided by change in quantity, and Q is the quantity sold. BQ will always be deducted from A because the idea is that the quantity sold will increase as prices drop and vice versa. If we look at this in graphical form, we can see the demand line showing an increase in quantity sold as the price drops. Using the demand line formula together with some more information, we can take this one step further to find the optimal price for a product. The first thing we need to do is calculate the demand line as seen on the previous slide. We then need to find the number of units we need to sell to maximise profit, and this is the point at which the marginal revenue, that is the extra revenue generated by selling one extra unit, equals the marginal cost, the extra cost incurred in making one more unit. We can find the marginal revenue, MR, by adapting the demand equation. It now becomes MR equals A minus 2BQ. Once we know what MR is, we will also know what marginal cost is, or MC, as they equal each other at the optimum point. As we already know A and B from the demand line calculation, and we now know what MR is, we can then find the quantity to sell at the optimum point, and then substitute this back into the demand equation to find P, the optimum price. Let's put some numbers to this to make it a bit clearer. A company charges $12 for a product and they sell 16,000 units at this price. If they change the price by $1 per unit, the sales volume changes by 2,500 units. The product has a variable cost of $5 per unit. From this information, we want to calculate the optimum selling price for the product. So step 1 is to use the demand equation to find any figures we don't yet have. To find B, we take the change in price and divide it by the change in quantity. So this is $1 divided by 2,500 units in this case, giving us 0.0004. We also need to find A, and we can do this by inserting all the known figures into the demand equation and then finding A as the missing figure. We know that when P is $12, Q is 16,000 units, and we have also calculated B to be 0.0004. So rearranging the formula, we can find A to be $18.40. The next step is to make MR equal MC. The marginal cost of making one extra unit will just be the variable cost of making that unit, and we know from the data that this is $5. So if the marginal cost is $5, the marginal revenue will also be $5 at the optimum point. Knowing that MR is $5, we can now use the A and B figures previously calculated to find a figure for Q at the optimal point. Here we now use the formula MR equals A minus 2BQ. Therefore, $5 equals $18.40 minus 2 times 0.0004 times Q. Rearranging the formula takes us to 0.0008 times Q equals $13.40, and therefore Q equals 16,750 units at the optimum point. The final step is to put this quantity back into the demand equation to find P. So this time P equals $18.40 minus 0.0004 multiplied by 16,750 units. And therefore P, the optimal selling price, is $11.70. We can also find the optimal price using a tabular method. Again, the objective is to find the output level and selling price that maximise profit. The easiest way to understand the tabular approach is to demonstrate it with an example. In the left-hand column of the table, we are going to show different output levels. In this case 10, 20, 30, 40 and 50 units of output. We are then going to record the total cost of making that number of units. So in this case it costs $10 to make 10 units, $25 to make 20 units, $45 to make 30 units, $70 to make 40 units and $100 to make 50 units. We can then work out the marginal or extra cost of making 10 more units at each output level. So to make 10 units from 0 units costs an extra $10. It costs an extra $15 to go from making 10 units to 20 units, an extra $20 to go from making 20 units to 30 units, an extra $25 to go from making 30 units to 40 units, and an extra $30 to go from making 40 units to 50. If we then look at the selling price at each output level, we can work out the total revenue we can generate at these output levels. $50 if we sell 10 units, $90 if we sell 20 units, $120 if we sell 30 units, $140 if we sell 40 units, and $150 if we sell 50 units. In the same way that we calculated the marginal cost, we can then calculate the marginal revenue at each output level. This will be an extra $50 when we sell 10 units, an extra $40 if we then sell 20 units, an extra $30 if we sell 30 units, an extra $20 if we sell 40 units, and an extra $10 if we sell 50 units. We can also find the profit we can generate at each output level by deducting the total cost from column 2 from the total revenue in column 5. At the output level of 10 units we generate $40 of profit, at 20 units $65, at 30 units $75, at 40 units $70, and at 50 units $50. So we can immediately see that the optimum output level is 30 units, as this generates the maximum profit. You will also notice that up to 30 units the marginal cost is lower than the marginal revenue, hence the rising profits. whereas after 30 units the marginal cost is higher than the marginal revenue, and therefore the profits start to decline. There is of course one major flaw with this approach, and that is that we can only work with discrete amounts and cannot find a precise output volume to maximise profits. Now that we have looked at demand-based pricing, we are going to move on and consider cost-based pricing. Basing our selling prices only on our costs means that all external factors that we have covered for demand-based pricing are completely ignored, and the price is purely set by taking the cost of making the product and adding on a markup or margin to arrive at a selling price. There are three cost bases we can use to calculate a selling price. The total or full cost, that is all fixed and variable costs, production and non-production costs. The total production cost, this time this will be direct labour, direct materials and production overheads, both fixed and variable. Or the variable cost, being direct materials, direct labour and variable overheads. In order to ensure that we are still making a profit, we then add on an extra sum of money to cover fixed costs, if we are using the variable cost basis, to cover non-production costs if we are using the production cost basis, and in all cases to generate a profit. We call this cost plus pricing, the plus being the element that we are adding on. Like with demand-based pricing, we can model costs and revenues using equations. By knowing how costs and revenues relate to each other, we can then determine an optimal output and an optimal selling price, just as we did with demand-based pricing. The equation we are going to use this time is y equals a plus b times x, where y is the total cost of making x units, a is the fixed cost, b is the variable cost per unit, and x is the number of units being made. This equation does assume that fixed costs won't change as output levels increase, and that the variable cost per unit is the same regardless of changes in production volumes. In reality, the learning curve effect might result in the variable cost per unit reducing as output volumes increase, and at given output levels the fixed costs might step up to a higher figure, but this equation ignores these factors. For more information on the learning curve effect, please see the video covering this topic area. The variable cost per unit may also decrease if bulk buy discounts or volume discounts are being offered by suppliers. If this is the case, then the total cost, y, will need to be calculated at different volume levels to ensure that selling prices cover the appropriate costs. Once we have established the cost basis we are going to use, we then need to calculate the selling price by adding on a markup or margin percentage. Remember that markup is a gross profit percentage based on cost, whereas margin is a gross profit percentage based on selling price. There are many advantages to cost plus pricing. It is easy to calculate and understand. It ensures that all costs are covered and a profit is made. Junior management can make pricing decisions based on figures and percentages provided to them. On the other hand, there are disadvantages, the main one being that there is no consideration of all of the external factors that we discussed for demand-based pricing. Other disadvantages are: in order to find the full cost, we need to absorb the fixed overheads into the cost per unit, and therefore a basis for absorbing those costs needs to be established. Budgeted output volumes will also need to be established to perform the task of overhead absorption. And the pricing strategy doesn't guarantee a profit. If sales are lower than forecast, fixed costs may not be covered. We are now going to move on and consider different marketing-based pricing strategies. The first of these is market skimming pricing. This basically means that when a new product or service is launched, higher prices are charged to maximise profits in the short term. In later stages of the product's life cycle, the price will drop as more companies start selling the same or similar products and as customer demand starts to drop. The overall aim is therefore to generate as much profit as possible in the early stages of the product's life cycle to compensate for the lower profits that will be generated later in the cycle. This type of pricing is particularly suited to high-tech products like mobile phones and computers. The new technology encourages customers to purchase when the product is launched, and therefore a higher price can be charged while still maintaining a strong level of demand. Given the short life cycle of these types of products, it is also good to get as much cash as possible back into the business up front to cover the costs incurred in developing and launching the product. It is also a good strategy to follow if demand for a product is unknown. Prices can always be reduced if demand isn't as strong as was hoped, but it is much harder to increase prices if demand is very high at low prices. In order to keep prices high, there needs to be some barriers to entry for competitors, such as a patent on the product preventing anyone from copying the design, high levels of upfront investment, or unusually strong brand loyalty, as is currently seen with Apple. Rather than skimming the market with the pricing strategy just covered, we can also aim to penetrate the market by setting prices low to encourage high sales volumes. This is called penetration pricing. Typically, prices are set so that products are sold at a loss or minimal profit to encourage consumers to buy the product in large volumes. The idea being that customers become accustomed to buying that product and will then continue to buy the product even when the price is increased to a more profitable level. You can often see this in action in the supermarket when new foods are offered at knockdown prices on the ends of aisles to tempt us to try the new product. We also need to consider other products or services that complement the one that we are establishing a selling price for, to ensure that the price of all complementary products work together. We call this complementary product pricing. So, for example, you might want to set the selling price for a particular printer fairly low, but the selling price for the cartridges that go with that printer fairly high. Once the customer has bought the printer, they will need to continue to replenish the cartridges for the printer, and therefore will be committed to buying the higher priced cartridges. A product line pricing strategy is needed where there are a number of similar products in the same range, and therefore prices need to be similar, if not the same, across the product range. The means by which the price is set could be demand-based or cost-based, with the same issues and factors needing assessment as covered earlier in the video. The prices that competitors charge may also be an influencing factor here. As already discussed from a purchasing perspective, volume discounts can be offered for bulk buying, whereby products are bought at a lower price when bought in higher volumes. The selling company need to think about how they would like their discounts to operate, or indeed if they are even going to offer them. Clearly, the main benefit of offering lower prices for higher purchase volumes is that the sales revenue will increase and cash flow should improve. New customers may well be keen to take up the offer too, so not only will you potentially generate higher sales volumes through your existing customer base, but you may also attract new customers that may continue to buy from you going forward. Volume discounts are also good if you are trying to sell off large volumes of surplus stock, or if a product line is coming to an end. The downside, though, is that profits will decrease as each unit is being sold at a lower price, with the same costs still being incurred in making or buying the stock for sale. It could be argued, though, that the reduced processing costs of processing fewer larger orders compensate for this loss in revenue and profit. A price discrimination strategy occurs when different prices are charged for the same product to different groups of buyers. This can only really happen if customers are split into different market segments, and customers can't buy at the low price and then sell on at a high price in a different market. A good example of this is train travel, where the same basic product, a journey from A to B, can be charged at varying prices, such as first class, peak and off-peak, for example. Finally, selling prices can be based on relevant costs, so we call this relevant cost pricing. This is often used when pricing up a one-off contract and when there is spare capacity within the business. The spare capacity indicates that fixed costs have already been covered by other products or contracts, and therefore only the incremental costs of this contract need to be considered when pricing it for the customer. The relevant cost of the contract is determined, and then a selling price is calculated based on this. The minimum price that should be charged is the total of the relevant costs, but more often than not a markup is added on to ensure some profit is generated by the contract. For more information on relevant costing, please see the video covering this topic. In this session we are going to explain the issues surrounding make versus buy and outsourcing decisions, as well as calculating the costs associated with each option to enable us to decide on the best option from a financial perspective. We are also going to apply relevant costing principles in situations involving shutdowns, one-off contracts and the further processing of joint products. I am going to assume that you have a sound understanding of relevant costing on which we are going to build these topic areas. So if you need to brush up on this area, please watch the video on relevant costing before going any further with this video. Before we have a look at any techniques for dealing with these sorts of decisions, let's first of all consider the issues surrounding short-term decision making. The first thing we need to consider is the resources available to us and whether there is any restriction on any of those resources. Where there are restrictions, we can of course use limiting factor analysis or linear programming to help us ensure that we make the best use of our scarce resources to maximise contribution and therefore profit. Further information on these two techniques can be found on the videos covering these topic areas. These techniques would be used when considering which products to make in-house and in what priority order. We also need to think about whether there are other options available to us when resources are scarce. Should we make the products in-house or should we pay to have them made? Within this decision, we not only need to consider the cost of buying the product in, but we also need to think about the quality of the product being made for us. If the product quality isn't as good as the item being made in-house, should the decision be made to outsource and risk a loss in reputation? Or should production be kept in-house to maintain reputation? Or is quality not a major factor for our customers? We should also think about continuity of supply and lead times if we are considering outsourcing production, as we need to ensure that we can meet customer demand. If we cannot meet demand, there is a risk that our customers will go elsewhere, and we will not only lose that sale, but we may lose all future sales to that customer. It is also wise to consider whether you will be tied to a supplier for a fixed period of time. What is the minimum contract term or minimum purchase quantity? Does this affect our future plans? If the resource that is scarce now becomes available in the future, we may want to stop buying the product in and start making it in-house again, given that it is likely to cost more to buy than to make. And it is also good to check whether the supplier has the appropriate skill set to replicate the product that we are currently making in-house. Or indeed, does the supplier have specialist skills that we don't currently have in-house or don't wish to focus our time on? Maybe we want to outsource our HR function so that we can focus on increasing our sales volumes and sales revenue. We could hire a specialist HR company to provide that service for us, thereby giving us time to focus on increasing those sales. There may be other factors specific to the company in question that also need to be considered, such as confidentiality, ethical considerations or union involvement if work is outsourced. This list of factors is not exhaustive but gives you an idea of the sorts of considerations that need to be taken into account, as well as the cost and financial implications when considering whether to outsource a part of our business. The rest of this video focuses purely on the financial impact of our decisions, but these other factors should be borne in mind before a final decision is made. Before we move on, we need to remember a few key features of relevant costing. So as a reminder, fixed costs are ignored unless they change as a result of the decision. We only consider future cash flows, and we only consider changes in those cash flows as a result of the decision we are making. So we are only interested in future incremental cash flows. Where there is spare capacity, it will usually make financial sense to make products in-house, as the variable cost of making will usually be lower than the cost of buying in a ready-made product. If, however, the cost of buying in does happen to be lower than the variable costs of manufacture, we would of course opt to buy in, as this will increase our contribution per unit and therefore our overall profit. Where there is no spare capacity and we are not meeting demand, we then need to consider which products we should make in-house and which we should buy in. To cover the technique we need to use, we are going to run through a numerical example. Funky Shirts Limited make 4 products: the retro, the vintage, the modern and the futuristic shirt. The material cost per unit is $5 for a retro, $6 for a vintage, $7 for a modern and $8 for a futuristic. Labour costs are $2, $4, $3 and $1 respectively, and variable overheads are $1, $2, $2 and $1. We can calculate the total variable costs to be $8 for a retro, $12 for a vintage, $12 for a modern and $10 for a futuristic. We also have the option to buy in each of these products at a cost of $9 for a retro, $11 for a vintage, $14 for a modern and $12 for a futuristic. We can immediately see that it is cheaper to buy in the vintage shirts than to make them in-house. So clearly it would make sense from a financial perspective to buy vintage shirts in rather than making them in-house. We also need to look at the fixed costs we might save by buying in products rather than making them. So if we assume that we would save $1,500 of fixed costs by buying in retro shirts, we would save $1,000 by buying in vintage shirts, we would save $2,000 by buying in modern shirts, and we would save $500 by buying in futuristic shirts. We can now work out the total saving or extra cost of buying in rather than making. We can now see that not only is it wise to buy in vintage shirts, but we should also consider buying in retro shirts, as we can make a saving of $500 based on a demand of 1,000 units. On the other hand, it costs an extra $4,000 to buy in modern shirts compared to making them, and an extra $1,500 in the case of futuristic shirts. As already mentioned, this decision is purely based on cost savings and does not take into consideration the other important factors already discussed. It should also be borne in mind that by buying in the retro and vintage shirts, this may result in there being idle labour or machine hours, which will still need to be paid for, and that this may not have been taken into account in the cost calculations we have just performed. An idle workforce can also result in an unmotivated workforce, and therefore efficiency might be affected and the labour cost per unit could start to rise for those products that are being made in-house. The next area we are going to look at is the decision regarding shutting down part of a business's operations. We are going to use relevant costing again here to determine whether the closure of a loss-making part of our business has a positive financial impact on the business as a whole, or if it makes more sense from the perspective of the whole business to keep the product line or department running. What this means is that we need to look at the cost savings associated with the closure, but we also need to look at the lost revenue resulting from that closure. The basic principle, therefore, is that we need to calculate the lost contribution, remember that is sales minus variable costs, resulting from the closure, and compare this to the fixed costs we would save through the closure. If the contribution lost is higher than the fixed costs saved, then it makes more financial sense to keep the operation running. Whereas if the fixed cost saving is higher than the lost contribution, it makes more financial sense to close the operation. Within the costing analysis, we should also ensure we cover any costs of redundancies, any potential legal action resulting from the closure, any retraining of existing employees, and compensation to customers awaiting products that they will now not receive. Again, this only takes into account the financial implications of a closure and not any other issues such as staff morale, customer and competitor reactions, the company's reputation, or the impact on our supply chain, and so on. Relevant costing principles can also be used for pricing up one-off contracts. The incremental future cash flows associated with the contract, such as increased labour costs, increased fixed costs, increased overheads and so on, need to be combined to find the total relevant cost of the contract. The minimum price will then be the total of these future incremental cash flows. If the contract price is lower than the relevant costs, then the contract should be declined from a financial perspective. There may, however, be other factors that mean a company would take on the contract despite the potential loss. This might be the case where a long-standing customer needs a one-off contract fulfilling, whilst the revenue from this contract might not cover the associated costs, it is highly likely that there will be more contracts coming our way in the future from this customer, so you would be more than happy to take the hit now to ensure these future profitable contracts. The final area we are going to cover on this video is the decision about whether to take a joint product or products and process them further rather than selling them at the split-off point. A joint product happens when two or more products are made from the same processing operation, and they are roughly equal in terms of selling price. A typical example would be processing milk to make yogurt and cream. For comparison purposes, a byproduct occurs when turning milk into cheese. The main product is the curd for the cheese, and the byproduct is the whey. We are only considering joint products here, and we are only considering those that could go through a further production process or processes to give rise to another product. As we are using relevant costing here, we are not interested in the cost of the joint product at the time of split-off, as these costs are effectively sunk costs. We want to decide whether to take the joint product and do more with it. At the split-off point, the joint product already exists, and therefore the costs in making it have already been incurred and are therefore sunk. We need to compare the extra costs of processing with the increase in the selling price as a result of the further processing, to determine if we are going to make more contribution by continuing with processing or by selling the product at the split-off point. So we need to find the incremental revenue that would be generated by the higher selling price of the product going through more production processes, and compare this to the incremental costs of those production processes. Where the incremental revenue is higher, we should go ahead with the further processing. But if the incremental costs are higher than the incremental revenue, then we should sell the products off at the split-off point without further processing. Do remember that we are only considering cash flows here, so any incremental costs, savings or revenues that are not cash flows should be ignored.
We are now moving on to the next phase in the management accounting syllabus, dealing with risk and uncertainty. We tend to use the terms risk and uncertainty interchangeably. In fact, they aren't quite the same thing. Risk is calculable. It deals with known possible outcomes and known or estimated probabilities. For example, there is a risk associated with tossing a coin. We don't know whether we're going to get a heads or a tails, but we know from experience it's going to be one of those two, with a 0.5 or 50% probability of each. We can therefore build this risk into decision making. However, with uncertainty, we may not know the probabilities of the possible outcomes. We may not have the experience with which to estimate them. We may not even know all the possible outcomes themselves. It is this element of certain aspects being unknown that distinguishes risk from uncertainty. Often, one person's uncertainty is another person's risk, depending on the level of experience they each have of the situation. Let's consider Jack, the owner of a sandwich shop. He's owned and run his sandwich shop for many years, so he has experience as to what demand may be for his sandwiches from his off-the-street customers. Per day, demand could be 100 sandwiches with a probability of 0.2, 200 sandwiches with a probability of 0.5, or 300 sandwiches with a probability of 0.3. This is the risky variable Jack has to build into his plans. Jack sells sandwiches for $5 each, and they have a variable cost of $2 associated with them. The owner of a local conference centre calls in to see Jack and offers him a contract to supply sandwiches every day. Jack is interested as he thinks that he has a total capacity to make up to 350 sandwiches a day in his shop and would welcome the chance to use up any spare capacity with a regular contract. To help the conference centre plan, Jack must sign a contract for the definite supply of a certain number of sandwiches for delivery each day. The options presented to him by the conference centre manager are to agree to a definite supply of 100, 150 or 200 sandwiches each day. The conference centre is only willing, however, to pay $3 a sandwich in view of their definite custom. Jack now faces a dilemma. His off-the-street customers earn him more profit. So if he agrees to supply, say, 200 sandwiches to the conference centre, he could easily be forced to turn more profitable business away. However, if he's only agreed to supply 100 sandwiches and demand from off-the-street customers is low, he might waste some of his capacity. Jack is trying to make a decision how many sandwiches to supply to the conference centre in the face of a risky variable, being demand for sandwiches from off-the-street customers. Jack can build a payoff table to help him with this. It has the decision variable across the top, he has control over this, and the risky variable down the side. He doesn't have control over this. We then fill in the table. For example, if we're in this box, then John has agreed to sell 100 sandwiches to the conference centre and have 100 sales to off-the-street customers. A conference centre sandwich earns $3 less $2 is $1 per sandwich, whereas a sale to an off-the-street customer earns $5 less $2 is $3 per sandwich. This generates a contribution of 100 times $1 plus 100 times $3 is $400. Moving down to the next row, here we've agreed to sell 100 sandwiches to the conference centre and have 200 sales to off-the-street customers. This is still within Jack's capacity constraint of 350 sandwiches. This earns him a contribution of 100 times $1 plus 200 times $3 is $700. Moving down to the next row, here we've agreed to sell 100 sandwiches to the conference centre and we have demand for 300 sales to off-the-street customers. However, we have a capacity limit of 350 sandwiches per day, so we can only supply 250 to off-the-street customers. We must supply 100 to the conference centre as we've signed an agreement to do so. This therefore earns us a contribution of 100 times $1 plus 250 times $3 is $850. Following the same process for the other two columns, we populate the payoff table. We'll be coming back to this table again and again in this part of the syllabus. How Jack uses this table will depend on his attitude to risk. Let's start off by assuming he is risk neutral. This means he makes his choices based on the balance of probabilities. He'll choose the option which, on average, will earn him the highest return. In other words, he will make his choice based on expected values. We need to now bring in probabilities. If Jack signs up to supply 100 sandwiches with the conference centre, on average he can expect to earn 0.2 times 400 plus 0.5 times 700 plus 0.3 times 850 is $685. If Jack signs up to supply 150 sandwiches to the conference centre, on average he can expect to earn 0.2 times 450 plus 0.5 times 750 plus 0.3 times 750 is $690. If Jack signs up to supply 200 sandwiches to the conference centre, on average he can expect to earn 0.2 times 500 plus 0.5 times 650 plus 0.3 times 650 is $620. So, on average, Jack's contribution will be maximised if he signs up to supply 150 sandwiches to the conference centre. This conclusion needs careful thought though, because it assumes Jack is risk neutral, it assumes the trial is repeated. You'll note that $690 is not an actual outcome, but will be the average over repeated trials. It assumes Jack has accurately forecast the probabilities for this risky variable, being off-the-street demand, and it assumes that if we turn customers away without selling them a sandwich, they'll try again another day and we haven't damaged goodwill. In other words, that the risky variable stays the same each time. In conclusion, when dealing with risk, we can undertake calculations based on the balance of probabilities if we are risk neutral. In our next video, we'll consider the need to build different attitudes to risk into our decisions. Welcome back. This is the second video considering the use of payoff tables and how they can help us to make decisions when faced with risk. In this video, we'll consider the impact risk attitudes have on our decisions, the value of additional information that's guaranteed to be correct, known as perfect information, and decision making with more than one risky variable. Let's remind ourselves about Jack, the sandwich shop owner. He was asked if he would like to sign a contract with a local conference centre for the regular daily supply of sandwiches, which, although they weren't as profitable as off-the-street sales, nevertheless helped use some spare capacity. We constructed a payoff table. The table shows the contribution that would arise depending on the decision Jack makes across the top and the risky variable down the left-hand side. We concluded that if Jack was risk neutral, he would make his decision using expected values on the balance of probabilities. We calculated this by multiplying the outcome by the probability of its occurrence. So for example, if Jack signs up to supply 100 sandwiches a day to the conference centre, the first column, he on average could expect a contribution of 0.2 times 400 plus 0.5 times 700 plus 0.3 times 850 is $685. We said that the expected contribution was maximised when Jack agreed to supply 150 sandwiches a day to the conference centre. This assumes he is risk neutral and is willing to base his decisions on the average outcome. Jack, however, may not be risk neutral. He could be risk averse or risk seeking. A risk averse decision maker is in essence a pessimist and assumes that poor outcomes will occur following their decision. They therefore make the decision that will make that poor outcome the best it can possibly be. This is known as the maxi-min approach, maximising the minimum possible return. We can use the payoff table again to help us here. We can use this table in a different way to help us with a maxi-min decision. Look at the first column. If we sign up to supply 100 sandwiches to the conference centre, the worst possible outcome is when off-the-street demand is 100. If we repeat this exercise for the second and third columns, the bottom row is showing us the worst case scenario or worst possible outcome associated with each decision. The best of these occurs if Jack signs up for 200 sandwiches with the conference centre. So, if Jack is risk averse, he will choose to sign up to supply 200 sandwiches a day to the conference centre, because if he does this and the worst happens, in other words, off the street demand turns out to be low, his outcome will be the best it can be in those bad circumstances. If Jack is risk seeking, he is by nature more of an optimist. He assumes good outcomes will follow from his decisions and therefore will focus on the upside potential. He will choose the option that gives him the maximum possible return. He will ignore the downside possibility attached to the decision. If we look at the table, the biggest possible contribution occurs when we sign up to supply 100 sandwiches to the conference centre and off-the-street demand is 300. We would earn a contribution of $850 in this case. This decision criteria is known as maxi-max. It maximises the maximum possible outcome. You'll note here Jack is being optimistic. If he selects this option, he is conveniently ignoring the fact that if off-the-street demand is low, he will only earn $400, the worst possible return. A slightly different approach to risk aversion is to focus on opportunity costs. A risk-averse individual may seek to choose the option that minimises the size of the error they made in hindsight. In other words, they don't want to be too disappointed when they look back that they could have made a better choice. This involves constructing a table of opportunity costs, which again uses the payoff table as a starting point. The opportunity cost table has the same structure and headings as the payoff table. The table is completed crossways, but read downwards. Consider the first row on the payoff table. If it turns out off-the-street demand was 100, then the best decision we could have made in hindsight would have been to accept an order of 200 from the conference centre. This would give the maximum possible return. The opportunity cost or regret would be 0. It was the best decision Jack could have made with hindsight. However, if it turns out off-the-street demand was 100 and Jack had agreed to supply 150 sandwiches to the conference centre, he would have secured a contribution of $450 rather than the $500 he would have gained if he'd agreed to supply 200 sandwiches. In other words, this is 500 less 450 or $50 lower than the optimum, or $50 opportunity cost or regret from having chosen the wrong decision in hindsight. If it turns out off-the-street demand was 100 and Jack had accepted an order for 100 sandwiches, he would have secured a contribution of $400 rather than the $500 he would have gained if he'd agreed to supply 200. In other words, this is 500 less 400 is $100 lower than the optimum, or $100 opportunity cost or regret from having chosen the wrong decision in hindsight. If we repeat this process for off-the-street demand of 200 and 300, in other words the other two rows in the table, we will have completed Jack's opportunity cost table. We use the table by reading down each column. For example, the first column. If Jack agrees to supply 100 sandwiches, his worst possible regret or opportunity cost is $100. In other words, at worst, he will be $100 off the best outcome he could have expected. So, Jack's maximum possible regret is minimised by choosing to supply either 100 or 150 sandwiches to the conference centre, as each choice has a maximum regret or opportunity cost associated with it of $100. This approach is known as minimax regret and is a form of risk aversion. Imagine Jack is poised to make his decision, let's say based on expected values, the risk-neutral choice. He's about to agree to supply the conference centre with 150 sandwiches regularly with an expected value of $690. The phone rings. A disguised voice says, "Meet me in the car park in 10 minutes. Curious, Jack goes and meets a man in the shadows clutching an envelope. The man says, "In this envelope is some perfect information. It will tell you exactly, with no doubt, what off-the-street demand will be. However, you'll have to pay me to obtain this information." Jack thinks he hasn't yet agreed to supply the conference centre, so once he knows what's in the envelope, he can supply the optimum amount to maximise his contribution. However, Jack doesn't know at this moment exactly what is in the envelope. As far as he is concerned, there is a 0.2 chance that off-the-street demand will be 100, in which case he would then agree to supply 200 sandwiches to the conference centre, earning him a contribution of $500. There is a 0.5 chance that off-the-street demand will be 200, in which case he would then agree to supply 150 sandwiches to the conference centre, earning him a contribution of $750. There's a 0.3 chance that off-the-street demand will be 300, in which case he would then agree to supply 100 sandwiches to the conference centre, earning him a contribution of $850. As Jack stands looking at the envelope, If he could obtain this information at no cost before committing to the conference centre, the value of his decision would now be 0.2 times $500 plus 0.5 times $750 plus 0.3 times $850 is $730. This is the value of the decision with perfect information. The value with no such information was simply the expected value he had calculated before the mysterious phone call, which was $690. The value of the perfect information is therefore 730 less 690 is $40. Provided he can purchase the information for less than $40, he will be improving his overall outcome by doing so. Of course, in the real world, no information is perfect, but this helps us to understand how much worse off we are because of a lack of perfect information, which might in turn help us to understand how much information is worth that reduces, even if it doesn't completely eliminate, uncertainty. More on this later when we look at decision trees. Sometimes we may face more than one risky variable. For example, suppose we're unsure as to what sales might be and fixed costs. We think sales might be with a probability of 0.5, 0.3 and 0.2 respectively. We also believe fixed costs could be $10,000, $11,000 or $12,000 with a probability of 0.3, 0.3 and 0.4 respectively. Suppose we wanted to calculate as a risk-neutral decision maker what expected profits are if contribution per unit is $4. Let's start by scheduling this out in a table. We're going to use this template 3 times. One table for profit, one table for probability, and a final table for profit multiplied by probability. Firstly, the one for profit. We populate the table with the profit that will result from every given level of sales demand and fixed cost. For example, in the top left-hand corner, sales is 1,000 units and fixed cost is $10,000. So profit is 10,000 units times $4 contribution minus $10,000 cost is $30,000. A similar approach for the other boxes gives us. Now the second table for probabilities. We start with the same template as before. Only this time we work out the joint probabilities. So for example, in the top left-hand corner, the probability of sales being 10,000 units and fixed costs being $10,000 is 0.5 multiplied by 0.3 is 0.15. A similar approach for the other boxes gives us the following. You'll note that the total of the probabilities adds to 1. Finally, the profit multiplied by probability table. Again, we start with the same template as before. This time we overlay the first 2 tables. For example, the top left-hand corner. Probability in this box is 0.15 and profit was $30,000. So probability multiplied by profit is 0.15 multiplied by $30,000 is $4,500. Then if we complete the other boxes, we get the following. As before, the expected value is the sum of probability times value. So if we add up all 9 values in this table, we could also say that profit will range from $28,000 to $40,000. We could also say, for example, that there is a 0.35 chance of profit being less than $30,000. This occurs in these 2 boxes, which have associated joint probabilities of, which totals to 0.15 plus 0.2 equals 0.35 or 35%. In other words, joint probability tables are useful things that tell us more than simply expected values. In this video, we've considered how to build risk attitude into decision making, how much perfect information is worth to us, and how to use joint probability distributions to help us with decisions. All these techniques assume we know probabilities and values. Often both are estimates at best. In this video, we consider the use of decision trees to help us make staged decisions and to calculate the value of imperfect information such as market research. A decision tree is a visual representation of a set of interrelated decisions that shows the reader a path through from one decision to the next. Let us consider a simple example. Jack is considering opening another sandwich shop. He thinks from experience there will be a 40% chance that the new shop will succeed, in which case it will be worth $1.1 million. If he launches a new shop but it's ultimately unsuccessful, it will lose him $700,000. He could, of course, decide to do nothing. He could firstly draw this out as a decision tree. Let's assume for these purposes Jack is risk neutral. Decision trees are drawn and read from left to right. A square node means a decision needs to be made. The decision maker can choose which route to go down from that node. In other words, Jack can decide whether to launch or not. A circular node is down to chance. Reading from left to right, we can see Jack initially has a choice of whether to launch or not. If he doesn't launch, his return is nil. If he does, then it's down to chance. This takes him to node B. There's a 40% chance of success and a 60% chance of failure. We calculate decision trees from right to left. So the first node that we would assess is node B. At a chance node, we calculate expected value. In other words, 40% times 1.1 million plus 60% times negative 700,000 is $20,000 positive. Rolling back to node A, Jack has a decision to make. He can choose which leg to go down, and he'll choose the leg with the highest value associated with it. If he launches, it will be worth the 20,000 at node A on average. If he doesn't, he'll get nil. So based on expected values, he will launch. This is a very simple example and can be extended so that one decision leads on to the next, but the principle is the same. Draw the stages out from left to right and calculate from right to left. At a chance node, calculate an expected value. At a decision node, choose the route with the highest expected value. Often in questions, the option will be given to undertake further research before committing. Typically, this research is imperfect. In other words, it reduces uncertainty but doesn't eliminate it, such as market research. Jack, for example, might consider undertaking market research before committing to opening his new shop. Although market research is not guaranteed to be absolutely accurate, good market research will give you a strong indication. So, early on in the decision-making process, there may be a choice, so springing from a decision node, of whether to do market research or not. As always, the decision path with the highest value should be chosen. If the path with research is higher than without research, then this additional value can be attributed to the imperfect information generated by the research itself. It is the value of that information over and above the price paid for it. This approach can help us, for example, to determine the maximum we will be prepared to pay for that information. Decision trees are useful as they help us to structure our thoughts and give clarity to a staged process. However, in the main, we're assuming there are limited options at each point, otherwise the tree becomes unwieldy. We know the probabilities and possibilities and are happy making decisions based on expected values. This latter assumption presumes we are therefore risk neutral. In reality, these points restrict the usefulness of decision trees, and these points should be noted in your exam if called upon to criticise decision trees as a technique. In this video, we consider testing our decisions to see how safe they are with sensitivity analysis. This technique also allows us to focus on those variables in a decision which we need to ensure our estimates are as accurate as possible for. We'll also consider simulations and scenario planning as ways of helping to further inform the decision maker before they make a choice. First, let's consider sensitivity analysis. Imagine Jack, who owns a sandwich shop, is considering launching a new line of yogurts to sell as desserts. He's done his preliminary analysis as follows. Sales price, $2 a yogurt. Variable cost, $1.25 a yogurt. Volume, 1,000 per week. And fixed costs, $500 per week. His forecast profit would be sales revenue of 1,000 times $2 is $2,000. Variable cost, 1,000 times $1.25 is $1,250, giving us a contribution of $750, less fixed costs of $500, giving us a profit of $250. On the basis that it creates a positive profit, Jack is poised to say yes and launch his new line of yogurt desserts. Jack is considering how robust his decision is. How sensitive is his decision to say yes to the various estimates in his original calculation? Firstly, sales price. How low would the sales price have to fall, assuming this affects nothing else in the process, before the profit is nil and Jack would decide not to launch? Sales revenue would have to fall by $250, everything else being equal, to wipe out the profit of $250 and reduce it to zero. This is a reduction of $250 divided by $2,000 is 12.5%, or a reduction down from $2 to $2 less 12.5% is $1.75. Jack would say he is 12.5% sensitive to his estimate of sales price. A lower percentage would imply increased sensitivity. Next, variable cost. Variable cost would have to increase by $250 to eliminate the profit and change Jack's mind, which is an increase of $250 over $1,250 is 20%, or an increase from $1.25 per yogurt to $1.25 times 1.2 is $1.50 per yogurt. Jack is 20% sensitive to his original estimate of variable cost. Next, sales volume. A reduction in sales volume affects both sales revenue and variable cost. In other words, it affects contribution. Contribution, and so sales volume, would need to fall by $250 over $750 is 33% to eliminate profits. This would mean a reduction from the current 1,000 units to 667 units per week. Jack is 33% sensitive to sales volume. Finally, fixed cost. Fixed costs would need to increase by $250 from the current $500 to eliminate the profit entirely. This is an increase of $250 over $500 is 50%. Jack is 50% sensitive to his estimate of fixed costs. Hopefully by now the approach is feeling familiar. In general, sensitivity is the amount we can stand to lose divided by the value affected by the variable we're looking at. For example, fixed costs again. The amount we can stand to lose is $250. The value affected by the variable we're looking at is $500, the fixed costs themselves. $250 divided by $500 is 50%. The decision maker can then focus on those variables with a low percentage when refining their estimates and considering their final decision. Unfortunately, although sensitivity analysis adds an extra dimension to assist the decision maker, it is not without its drawbacks. Firstly, it's not an optimizing technique. In other words, it doesn't give you a yes/no answer in terms of should I continue. It simply says, if you're wrong by more than X%, you've made a mistake. Secondly, it doesn't include any consideration for how likely you are to be wrong. For example, it looks like you should be concerned about a variable with, say, only 0.5% sensitivity, but if the number concerned is a solid number, for example, if you have a binding quotation from someone, so it simply isn't going to be wrong, there's no need to worry. It also only looks at one variable changing at a time. This is clearly unrealistic. In the real world, variables are interrelated and tend to change all at the same time. There's a technique that can help us here though. It's called simulation. With Jack's yogurt decision, he used what are known as point estimates for each of the variables. In other words, he gave each variable one number. Take sales volume, for example. Jack estimated sales volume as being 1,000. In reality, of course, it could be higher or it could be lower. If we had the experience or could do sufficient research, we might produce a more detailed probability distribution. Many variables are normally distributed. In this sense, the word normal is a technical term. Here is an example of a normal distribution that might better represent the potential volume of sales. It may have an expected average of 1,000 units, but it could be higher or could be lower. Very much higher or very much lower is, however, less likely than just being a little bit higher or lower. How widely spread around the average the curve is described by the standard deviation, or sigma. For example, here is a distribution with a large standard deviation, and here's a distribution with a small standard deviation. The standard deviation is calculated using this formula, where EV stands for expected value or average. In our example, this is 1,000 yogurts. P is probability and X is a possible outcome. Suppose, for example, some basic research showed the following: 1,000 units with a probability of 0.5, 800 units with a probability of 0.25, and 1,200 units with a probability of 0.25. The expected value is calculated as 0.5 times 1,000 plus 0.25 times 800 plus 0.25 times 1,200 is 1,000 units. The standard deviation can be calculated by building up a table as follows. The standard deviation would be the square root of 20,000, which is 141. Getting back to Jack, he could replace one or more of the point estimates with probability distributions, many of which may be normal distributions like we have considered. He, or rather a computer he is using, could then combine together the probability distributions to come up with a probability distribution of profit rather than the current point estimate of $250. It might look something like this. Jack can then see the range of profits he may achieve and the spread or how variable those profits may be. Although once again this is not an optimizing technique and that it doesn't give him a yes/no answer, it nevertheless gives him a more realistic picture of what the future might hold. All this assumes, of course, he can get reasonable information on the underlying probability distributions in the first place. This may take lots of time and expense, and so in the real world is often reserved for decisions where very large sums of money are involved. Don't worry, in your exam you won't be expected to prepare a simulation only to talk about how they work, what they show, and the pros and cons of doing them. You may be required to calculate a standard deviation, but nothing more. Lastly, let's consider scenario planning, or what-if analysis. Often, organisations will consider a series of plausible future events to map out how they might affect the business and how the business could plan in advance to respond. For example, an airline might consider what happens if fuel prices increase by 30%. This does rely on there being sufficient skill and experience in the organisation to consider which variables to focus on, but it can be a useful tool to help organisations plan in advance. In conclusion, we've seen that sensitivity analysis, simulations and scenario planning are all useful tools to help the decision maker when facing risk and uncertainty, albeit no method is perfect. For your exam, make sure you can perform the necessary calculations, but also be prepared to interpret the result and discuss the advantages and disadvantages of the methods themselves.